your presentation. Thank you very much. I am Shinkai, CFO. So this is the finance part. You already did hear from Mr. Shibata about the strategic agenda, but then here I'd like to explain that in numbers and also talk about updates of our capital allocation. So moving on. So first, allow us to recap some of the recent activities. So ever since 2021, all the way to the first half of 2022, here we have some of the recaps, and you can see that we've been having a pretty busy 18 months, starting with M&A, capital injection, and we have tried to make sure that we'd be able to enhance the shareholder return in this course of time. So I will be talking about our future capital allocation plan, but with that, I'd like to move on to the next page. So versus the long-term target, I'd like to give you the progress to date. And so again, looking at the middle shaded part. So here we have the adjusted base first half performance. Now, 100 yen versus dollar and 120 yen versus euro is the currency rate that we've been using as we try to adjust ourselves to a long term. And so therefore, we can see that revenue is 6,231 oku yen, gross margin 58%, OP margin 38%. That's where we are. Now, ever since 2020 into 2022, if we look at how we've been doing so far, for example, the run rate sales, we have been able to grow this revenue by 40%. And Dialogue acquisition has been able to contribute by 10 percentage points. In other words, the organic growth otherwise would be like 30%. Gross margin, we have been able to enhance the scale. And so that is why the margin has been enhanced. And of course, there has been offset by the increase of the production side of the cost, but it has been well offset by the entire scale growth. Operating margin, we have been able to do this very good leveraging. Maybe this is something that I did talk about in the past, but we have been able to do some SG&A control. Now, even though revenue has been growing, if we look at how we've been able to do on the first half, the SG&A has been flattish year over year. And that is why the operating leverage has been able to have a positive growth, positive performance. So we have been able to make a pretty good progress so far. And as we look into the midterm, long term, we're hoping that we be able to work within the type of the run rate that we've been able to do so far. Moving on. So again, this long-term model, if we try to look at this per segment, this is how it looks like. So the basic story has not changed ever since we set the entire scenario. And just as a reminder, so the target for the sales is, the SAM has been set, looking at the overall industry growth. And automotive is pretty much in line, and industrial infrastructure IoT is ahead of the industrial growth. And so we have been able to be ahead. And so overall, we're trying to be ahead of the industry. And so again, on the automotive side, the automatic control, for example, our main product MCU, our H850 series, is the core product that we are able to grow in tandem with the market growth. And this is very much the foundation of the automotive business. And other drivers would be ADAS and EV. Especially for EVs, we have decided to make an investment so that we'd be able to increase our production capacity for IGBT. And that is going to be a good driver. Now, industrial infrastructure and IoT. First of all, the industrial side, there's the MCU, MPU. There's the digital product that that enables us to grow ahead of the entire industry in the market. There has been the recent acquisition of the Realty AI, and that is also going to accelerate the growth. Infrastructure is going to be the data center and BTS analog. And for IoT, we have that application, but then you can see that there are a lot of products that we'd be able to focus so that we'd be able to have a very long tail type of acquisition of the growth. There's been a Dialogue, and there's also the Serum Celeno acquisition, and so that enables us to have a good growth here. And atop with the combination of the conventional other digital products, that we are now able to offer more solutions to our customers. Now here we look at the gross margin outlook. So in 2021 and 2022, we have tried to increase the capacity, and so we have included that in our updates. So there are four elements. And so there has been the capital capacity increase investment. And so there's the negative impact from the depreciation and also the positive from the automotive growth. There's also the growth coming from industrial infrastructure IoT. And so the target is to achieve 50 to 55%. At the moment, we are expecting that we will be able to go within that window. Now, depreciation, again, we are investing for capacity increase, and it is going to start operation from 2024, which means the depreciation will be scaled from here off. And at the same time, there will be new investment, and around 2026, 2027, that's probably going to be the peak out of the investment. So the depreciation peak out would follow. As for the automotive growth, I talked earlier about the drivers coming from EV, but power discrete, relatively, that is a lower margin, but this is on the other side, there is going to be the scale increase, the volume increase. So, this also means that the contribution to the gross margin may not be that large. Moving on to the next page. Here we talk about the capex and capacity expansion. Left-hand side looks at the capex outlook. In 2021, the 15% amount of sales was allocated for capex. And half of this is for the capacity at the half. The capacity increase is the half of the capex, but then a lot of them will be used for the Kofu revamping. And the long-term model itself has not changed. In other words, it is going to be 5% versus the sales. And from 2023 and onwards, we're trying to make sure that we quickly will be able to control the size of the capex so that it would fit within that 5% range. And on the right-hand side, we also look at the capacity. And so because of this capital expenditure, the internal production will be able to increase by 20% by product and by diameter. The Kofu, there is the restart of the 12-inch, and so the 12-inch capacity will be increasing. So there's a net increase there coming from Kofu. But then also, there's also some details about what products that we're talking about. Now, the blue part indicates the products for automotive, and the purple indicates the products that would be going for industrial IoT. IGBT, power MOS. You did earlier hear from Mr. Shibata that we're trying to go for fab light. And this is something that we'll be doing within the internal production. Again, what is going to help this is the production at Kofu. Now for analog, it is increasing, although not large, but it is increasing. And for example, some of the products here will be the former Intersil products. We will be producing more internally. And after the acquisition, it's already been almost 5 years, but some of the cross manufacturing is really making good performance. So the dual fab is something that we will be able to execute more. And also you find MCU at the bottom, 130 and 110 nano, and also 140 for automotive side, and other for consumer products will be produced internally. So that is something that we're also trying to pursue. And we are also thinking of using our internal factories as like a multi-fab. And we might also be able to include, for example, all the way to the foundries to do this multiple fabs so that we'd be able to enjoy more resilience in our production. Moving on to the next page. So from here, we also look at the operational resilience. And we're trying to control the performance volatility. So first of all, as for the margin, that is on the left-hand side. Ever since the first half of 2019, we're trying to compare what we've been able to do. And we're also, you can also see the margin notch has been accelerating. Now, of course, there is the tailwind from the external environment during that course of time, but you can see that we have been able to enjoy this growth here.
It is notching up, and that's fine. But on top of that, we are reducing volatility, and that is we are looking at reducing volatility. And the specific initiatives to be taken is indicated to the right. Now, in the short term, on the supply chain, also sales side, we will look at order intake and also management. We will work on these matters so that we are able to match the supply and demand, so that we will be able to reduce any over or reduced production. And we have to look at the final demand, and we'll look at the final or end users. We will interact directly to identify how much of a demand will actually materialize for these individual products, and will take early action. And thirdly, die banks. Temporarily, from the viewpoint of BCM, we need to enhance resiliency. And for that matter, we are looking at possessing a die bank. But on top of that, we will reduce lost opportunities and also stabilized production. And we believe that die bank will contribute. And down below, we are looking at the long-term initiatives to be taken. This is enhance, of course, the cost structure. We will work on fab light initiatives using foundries that will allow us to control cost, so that we will move above a break-even point. We will also work on creating synergy, and thirdly, hedge against forex volatility. Currently, we are looking at the cost mix, and of course, the Japan yen accounts for a large proportion, and therefore sensitivity is very high against forex changes. But as we work on using more foundries and also on OPEX, we have to look at globalization, and that will allow us. That will also mean that the proportion of foreign currency will also increase, and the yen-based sensitivity to foreign forex developments will be reduced, and we'll also use financial instruments to hedge against forex, so that we will be able to reduce our exposure. And moving on, here we were talking about the operational resilience regarding operation and manufacturing against, of course, earthquakes and other disasters, for example, lightnings. We hope to be able to reduce suspension to operations. And to the left, we are looking at the front end. We are looking at the immediate implications from natural disasters and how that translates to numbers. In terms of the operations, there have been losses on operation days, and also the blackouts. There have been implications in the way of damages to wafers, and that is expressed in numbers here. With earthquakes, when there's damage to plant devices, in the interim, we'll have to suspend operations, and when the blackouts occur for a prolonged period of times, there will be wafers that will need to be discarded, and these are the implications. And we need to reduce on these implications, and therefore various initiatives are being designed. To the right, we have these, first of all, preventive incidents, so that we are able to prevent destruction and also to reduce a blackout prolonged period. And down below, we have strategic initiatives. In order to reduce suspension of production, we will have inventory. The first by which we hope to be able to do this is to have a die bank. This will allow us to bridge against any stockouts. And we need to also ensure BCM stocks for SIV materials. When these are destroyed, the implications will be very disruptive, and also the lead time for return of production will be prolonged, and therefore we are required to have a substantial inventory for the purpose of business continuity, so that we are able to shorten the lead time for resumption of operations. And as a result of these initiatives to be taken, the total inventory, of course, need to be substantial. In terms of DOI, more than 100 days worth of inventories will be required, and that is a target that we have in mind. And moving on, and last I would like to talk about capital allocation for the time being. This is what we have in mind. Firstly, organic growth need to be achieved. We will increase productivity investment into enhancing capacity of production, and this will be conducted as planned. And secondly, this is in reference to financial soundness. Net leverage for the time being, less than 1%. We're progressing smoothly. M&A, we're taking active measures to acquire complementary technology. And also in terms of financial soundness, even if there is a capital shortage, we will be able to set a target which is achievable at 1.0 times of net leverage. Shareholder returns, we will resume dividends, and we are studying this within 2 or 3 years. And we are currently working on a tangible plan for this to happen. And that's just to offer a few comments from the appendix slides. And here we're looking at the midterm model, the assumptions that is described here. I hope they will take a look in your spare time. And continuously, we have been reporting on this area, progress on synergy, winning combination design in, and also cost synergy progress. There have been some reshuffling of the components. However, as we look at the progress made, this is very positive. And this will conclude my explanation. In the updates offered this time around, there's not a lot of change from the previous updates, but when it comes to investment into growth and also shareholder returns, we will continue to place an emphasis. So there's not a change there. And of course, we need to enhance, of course, a certainty. And I hope that this will be the message that has been